York Timber's interim headline earnings per share were flat at 13 cents. Revenue for the period rose 5% to 590 million rand, driven by higher selling prices for lumber and plywood. York said that despite significant cost pressures from escalations in labour, fuel and electricity costs, they remain poised to advance their current market position. And as mentioned, joining me now in studio is the CEO of the company, Pieter van Zyl. Thanks so much, Pieter, for joining us this afternoon. Well, let's get straight into it. I mean, looking at the kind of market you're catering to that's resulted in these numbers today.
I think that we're still heavily dependent on the residential sector. That market we've seen flatten off a little bit to the latter part of last year. On the infrastructure side, which we mainly service through our plywood products, that was very strong. We had strong growth in terms of volume and also price increases. So in terms of the market demand, yes, the products that we supply, there is still a fundamental need for those products. So we're not too negative about the outlook.
So that the demand scenario, let's take a look at the supply side of things, because some challenges experienced there where you had industrial action impacting supply and then distribution of that supply as well.
Unfortunately, you know, the last 6 months was you can say characterized by, you know, a lot of labor unrest, not just in the mining sector but also in the timber industry, the transport as well. It's an unfortunate event. We thought that we would recover some of those lost sales. We did not fully recover those sales over the period, and it seems like, looking at where the market is now, we lost those sales. I think we should not be too overly disturbed or worried about, you know, the labour market. I think things will settle down. There needs to be a restatement of the minimum wage rate, which seems to have been happened now. And it's up for companies like us to find solutions to these cost pressures.
How can you mitigate against this risk moving forward? What plans do you have in the pipeline to, to counter effects like these moving forward?
We have a philosophy in York talk about cost optimization. So if you just look at the cost driver per se, and let's say the minimum wage rate, then one would get stuck into see how we can cut that specific cost item. Our philosophy is slightly different. We're looking at the other factors impacting that specific cost element. So it's elements of, you know, how do we transport our workers to their workplace. It's the elements of where they stay, the so-called other cost items that impacts your wage bill. From our perspective, you know, overtime costs, the effectiveness of employing your labour, you know, finding different techniques in order to get a better result, all of these things form part of that optimization philosophy. And that is our strategy in order to absorb these increases.
Let's take a look at how you're looking to extract maximum efficiencies, because you're having to, like a lot of players out there, deal with a higher operating operating environment, fuel and electricity costs this time around really coming to bear on your numbers.
The challenge for us lies to see how we can utilize our current installed capacity more effectively. It's a capital intensive industry, and therefore when you have a huge sunk cost element in your business, you need to leverage that to the full potential. Before York operated more than 7 operating plants. Today we're in the region of 5. So effectively we have scaled down, you know, in terms of these, let's call it, ineffective operations. So we believe that, you know, that when you spend capital, it has to give you an advantage. Our strategy is to be the cost leader in our industry. In this current environment, the cyclical product, you know, the building and construction sector, very cyclical. So we believe that, you know, our differentiating factor is that we're quite cost competitive in this market.